So this is the Canadian Mortgage and Housing Corporation, the CMHC Mortgage Industry Report. Last video, we took a look at the most popular mortgage term chosen, which was the short-term fixed, and we went over why that might be. In this video, we're going to go over other pieces of data that are included in the report, and this is an interesting one to start with. The share of mortgages belonging to different lender types. So there are different types of mortgage lenders. Of course, you probably know the big six banks and credit unions. There are other chartered banks, HSBC for example, and then there are non-bank lenders who are both regulated and not regulated. Most importantly, I want to point out the red here, which is mortgage investment entities. Now, a mortgage investment entity or a mortgage investment corporation is usually a pool of money coming from investors, and then that money is used to be loaned out for mortgages. And the reason why I bring this up is because private mortgage lenders would be included in here. Private mortgages are mortgages, so they're loans against a property, but they're used for investors or emergency situations. You may have also heard them referred to as hard money loans. They have high interest rates, fees attached to them, and are usually interest-only payments. Now, it's important that we understand the difference between these two charts. This is the current split between different types of lenders of existing mortgages, so mortgages that are already loaned out. This chart shows the split for new mortgages, so mortgages originated in this time period, and for that it is Q4 of 2022, so there's a bit of a lag, but this information is still relevant. The difference between these two charts show a noticeable difference of more mortgages going towards private lenders and B lenders or subprime lenders. A couple of months ago, there were a lot of stories about the rise of private mortgages, and whenever you increase the interest rates, this is to be expected. There are investors or property owners that are finding it harder to qualify at traditional mortgage lenders because the rate increases have made it harder to qualify for a mortgage. So in an attempt to keep the property or even secure a property, you see more borrowers going towards privates and B lenders. Another thing I wanted to look at are delinquency rates, so that is what percentage of different types of debt are not being paid. Now, it's hard to see in this chart, the scales are not well chosen to see the changes, but it is the delinquency rates over time for credit cards, auto loans, home equity lines of credit, regular lines of credit, and mortgages. Everything but HELOCs and mortgages have been going up, and keep in mind, this is the last quarter of 2022. I can tell you right now, since the big banks have released their Q2 numbers for 2023, that mortgage delinquencies have been ticking up ever so slightly. Two ways you can take this. As you see, during the pandemic, these numbers dropped significantly, and so the rise in delinquency rates can very well be a return back to pre-pandemic levels. Another perspective going even further is that these delinquency rates are going to continue to increase because the cost of servicing debt has shot up. And that's a reasonable conclusion. If you're going to increase the interest rates at the speed we did, you have to expect more borrowers are going to miss payments. Now, whether this trend is going to continue and coincide with a recession and you'll see houses come onto the market because of forced selling or missed payments, that is yet to be seen. But things like credit cards and auto loans tend to front run the delinquency rates for mortgages. You can see in this chart that mortgage delinquencies and HELOC delinquencies are still very low, but that probably has to do with the fact that mortgages are a lagging indicator. It is the last thing a consumer will miss a payment on. Another thing that I wanted to point out is that the delinquency rates between consumers who have mortgages versus consumers who do not are actually significantly different, which is something I believe most people don't know. That's all for this one. There's more data in this report, but I only wanted to pick out the things that I found interesting that you guys would also find interesting as well. Here's some more content about why interest rates are going up in general, and thank you very much for watching.